Welcome back to Investing Talk Podcast.
Great to be here.
Today we're doing a deep dive into Polestar Automotive Holding UK. You sent over a stack of information covering their recent performance, financials, market position, and future outlook.
That's right. A lot to dig into.
And our mission. Well, it's to help you unpack all of that, figure out what the key numbers are, what they actually mean, and what really stands out from all this material.
Looking forward to it. There's certainly an interesting player.
They are. Just before we jump in, if you find these deep dives helpful, please do remember to subscribe, like, and leave a comment. It really helps us bring these conversations to you.
Definitely helps keep the lights on.
It does. And if you feel inclined, you can even consider buying us a coffee to support the show. Okay, now let's get into it. Polestar.
Right. So Polestar, they operate within the automotive industry, and their focus is very much, zeroing in on electric mobility, premium EVs.
They have a pretty distinct identity, don't they? It feels like it's not just about making electric cars.
No, exactly. It's very much centered on that Scandinavian design aesthetic. Clean lines, minimalist feel.
Combined with high-performance EV technology, as they put it.
That's the pitch. And that design focus, it's definitely intended as a differentiator in a crowded market.
And where are they focusing their efforts? Which markets?
They're targeting major markets globally. Significant presence in places like Europe that includes the UK, of course, the US, China, Korea. Quite a widespread already.
Okay. And their product portfolio is clearly expanding. What models are actually available right now for people to buy?
Currently, you'll find the Polestar 2, which has been around a bit longer, and then the newer SUV models, the Polestar 3 and Polestar 4.
All right, the SUVs. And what's next on the horizon? What are they bringing out soon?
Looking forward, the key one everyone's watching is the Polestar 5. That's anticipated in the second half of 2025.
Okay, the Polestar 5. Tell us a bit more about that one. It sounds like there's some interesting engineering behind it.
There is. It's designed as a performance-oriented four-seat Grand Tourer, a GT.
Ah, okay. So moving up market a bit.
Seems like it. And what's technically notable is its in-house developed bonded aluminum platform.
Bonded aluminum. So not traditional steel.
Right. It's a lighter, potentially stronger structure, more complex to manufacture usually, but it offers performance benefits, handling, efficiency.
Interesting. What else?
It also features an 800-volt electrical system.
Oh, okay. That's significant, right, for charging.
Exactly. It allows for much faster charging compared to the more common 400-volt systems you find in many EVs today, so less time plugged in.
That's a big selling point. Any other models planned?
Beyond the 5, they have plans mentioned for a Polestar 7, which is intended as a premium model and, interestingly, planned for European production.
Okay, so summing up their approach, combine that premium design and advanced tech, push sales volume, and rapidly grow their global retail footprint, often using partnerships.
That seems to capture the core strategy.
Based on what we've seen, what would you identify as their core strengths right now? What's working for them?
Well, their brand and design leadership in that premium EV space is definitely a strength. People recognize the look. They also smartly leverage platforms from Volvo and Geely. That gives them efficiency and access to proven technology, which is a huge advantage for a relatively new player. Saves a lot of R&D cost and time.
Makes sense. And the Geely connection.
Geely's strong backing is absolutely crucial. It offers strategic support and, importantly, potential access to necessary funding, which is vital in this capital-intensive industry.
Right.
And as you mentioned, the expanding product range, especially with innovative models like the Polestar 5 coming up, is a positive signal for future growth potential. You need new products to keep momentum.
Okay, let's shift gears then and unpack the recent performance data, specifically focusing on the first quarter of 2025. What do those latest numbers reveal?
All right, starting with revenue. Polestar reported $608 million for Q1 2025.
$608 million. How does that compare?
It represents a substantial 84% increase compared to the $330 million they did in Q1 of 2024. So significant growth there.
Wow, 84% year over year. That's huge.
Yeah.
If you sort of annualize that, what kind of run rate are we looking at?
Well, based on prior reports and just extrapolating that Q1 number, you're looking at a run rate sort of around $2.3 billion. It's a big jump from previous levels.
That kind of top-line growth is certainly eye-catching. How many actual cars does that translate to in terms of sales volume?
Good question. The retail sales volume in Q1 2025 was approximately 12,304 cars sold.
Okay, and the growth there?
That's up 76% year over year, also a very strong increase.
And how did that compare to the previous quarter, Q4? Did they keep the momentum?
It's also worth noting, yeah, that this volume remains stable compared to Q4 2024. So they held steady sequentially, even in what's widely described as a more challenging market environment for EV sales globally right now.
Holding steady in a tough market is pretty good. So they're selling a lot more cars, bringing in significantly more revenue. But the big question, as you know, for Polestar has always been profitability. Have the financials started reflecting that growth on the margin side?
This is where we see some genuinely encouraging signs. The gross margin showed substantial improvement. It reached a positive 7% in Q1 2025.
Positive 7%. That's a big deal for them, isn't it? Weren't they negative before?
Exactly. It's a really significant shift, a jump of 15 percentage points from previous negative margins.
Right. And what does that positive gross margin actually tell us?
It tells us that at the basic level of just selling the car and accounting for the direct costs of producing it, they are now, on average, making money on each vehicle sold.
Before overheads and R&D and all that.
Precisely. But it suggests real progress in operational efficiency. Maybe getting production costs down, or perhaps a better mix of sales skewed towards higher margin models or trims.
Okay, positive gross margin is a critical step, definitely something investors wanted to see. But it doesn't tell the whole story about overall profitability. After all the other expenses, were they profitable on the bottom line? Net income?
Not yet, no. The net loss was still negative, which, frankly, is expected for a company in this heavy growth and investment phase.
But did it improve?
It did. The net loss was reduced by 31% year over year in Q1 2025, so less money being lost overall.
Okay. And what about EPS, earnings per share?
The reported EPS, which gives you that snapshot of profit relative to the number of shares, was negative $0.19 for the recent period reported.
Negative 19 cents. How did that compare to what analysts were expecting?
Interestingly, this actually missed analyst estimates, which were around negative $0.12. So Wall Street expected slightly less red ink, it seems.
Okay. A slight miss there. What about other measures like adjusted EBITDA?
The adjusted EBITDA loss, that's earnings before interest, taxes, depreciation, amortization, kind of a proxy for operational cash flow, that also showed significant improvement. It shrank by 46% year on year.
Okay, so losses narrowing across the board, both net loss and EBITDA loss improving significantly. That suggests operational leverage is maybe starting to kick in as sales scale up.
That's exactly what it points towards, yes. As they sell more cars, the fixed costs get spread out more.
Right. What about their financial health, though? Access to cash? Liquidity? That's been a concern.
Absolutely critical. At the end of Q1 2025, their cash position was approximately $732 million.
$732 million. Is that enough, given they're still losing money?
Well, crucially, during that first quarter, they also secured or renewed over $900 million in financing facilities.
Okay, so fresh funding lines.
Yes. This significantly bolsters their liquidity and provides important financial flexibility for the near term. It's vital breathing room for a company with persistent net losses and, historically, a significant rate of cash burn.
You mentioned the information provided also pointed out some areas where detailed financial data wasn't immediately available in these recent reports.
Yes, that's an important caveat to mention. Specific, up-to-date figures for some key balance sheet metrics like debt to equity or cash flow metrics like free cash flow weren't explicitly detailed in the latest Q1 release materials.
Free cash flow is a big one people watch for cash burn.
It is, and given they are still reporting net losses, return on equity isn't a particularly meaningful positive figure yet anyway.
And there was a note about official filings.
Right. The material indicated that the full audited SEC filings, specifically the Form 20F for the end of fiscal year 2024, might be incomplete or delayed.
So what does that mean for investors?
It just means that for a complete, detailed picture of the balance sheet and potentially other metrics, you'll need to consult upcoming regulatory filings when they become fully available.
Got it. So putting all these Q1 financials together, what's the main takeaway? What stands out most?
Well, what's really striking is the tangible evidence of operational improvement. The strong revenue growth is clear, that's number one.
Right.
And turning the gross margin positive to 7%, that's a critical milestone. It indicates they're getting more efficient at actually building and selling the cars.
Okay.
The fact that both the net loss and the adjusted EBITDA loss are narrowing significantly suggests that, yes, operational leverage is starting to work as they scale up volume. That's the positive story.
But there's always a but.
There is. You have to balance this clear progress against their history of pretty considerable cash burn. While the recent financing definitely improves the near-term liquidity picture, those persistent net losses are still a significant point of focus. Managing that cash position effectively remains absolutely critical for them going forward.
Okay, that provides a clear picture of their internal performance. Let's widen the lens now and place Polestar within the broader industry context. The EV sector is just incredibly dynamic and, frankly, hyper-competitive right now, isn't it?
It absolutely is. It's marked by really rapid technological innovation. Things are changing constantly. You've got shifting consumer preferences and a huge influence from regulatory pressures like emissions targets around the world.
And who are the main players they're really competing head-to-head with in this space? Who do you see as their key rivals?
Well, obviously, you have the established global leader, Tesla. Known for its scale, its massive supercharger network, constant software updates, and maybe most importantly, its strong profitability and cash flow generation. It set the benchmark in many ways.
Right. Hard to ignore Tesla. Who else?
Then you have players focused heavily on specific markets, like NIO in China. They're known for things like battery swapping tech. They're expanding globally too. But like Polestar, NIO also faces significant pressure on profitability despite growing revenues. They're still losing money.
So similar challenges there. And the legacy guys.
And you absolutely cannot forget the legacy automakers. Companies like Ford, Volkswagen Group, Hyundai, Kia, they are aggressively accelerating their own EV launches now. They're leveraging their vast manufacturing resources, existing dealer networks, and brand recognition. The competition is heating up from all sides.
Given that really intense competitive landscape, where does Polestar seem to be trying to stand out? What's their angle?
Polestar positions itself strongly on its premium design appeal, that distinct Scandinavian look, and the innovative technology platforms it's developing. You mentioned the Polestar 5 tech earlier.
Right, the bonded aluminum 800-volt system.
Exactly. Now, while they are nowhere near Tesla's scale or profitability yet, they are competing directly in that premium EV segment. They're up against both the newer EV entrants and the rapidly evolving electric offerings from those established luxury brands like BMW, Mercedes, Audi.
Sustainability is also a big part of the Polestar brand story, isn't it? They talk about it a lot.
It is, and they do highlight their efforts there. They've reported reducing greenhouse gas emissions per car sold by nearly 25% since 2020.
That's quite a reduction.
It is, and it aligns with broader global sustainability goals. It certainly enhances their brand value, especially with that growing segment of consumers who prioritize environmental considerations when they're buying a new vehicle, particularly a premium one.
Makes sense. And beyond the direct competition between car companies, what external factors are influencing the playing field for everyone, including Polestar?
Well, a big one right now is international trade policy and tariffs. Things are very fluid, let's say.
You mean between the U.S., China, Europe?
Exactly. Changes in tariff structures between these major regions can significantly impact supply chains, manufacturing costs, and ultimately market access for all EV manufacturers. Polestar is not immune to this. It adds a layer of unpredictable risk and cost pressure for everyone.
Okay, so considering everything we've just discussed, the recent performance, the tough market context, the external pressures, this brings us to a really important question about the balance of risks versus opportunities facing Polestar right now.
It really does. There's potential, but also significant hurdles.
Let's start with the potential upsides. What opportunities stand out from the information we have?
Okay, opportunities. Well, the strong revenue growth and, critically, those improving margins we talked about, they're perhaps the most immediate opportunity. It suggests the company is starting to benefit from economies of scale and operational improvements finally taking hold.
That's key. What else?
Their demonstrable sustainability achievements, like that emissions reduction per car, enhance brand value and appeal, particularly in environmentally conscious markets in Europe.
Right.
Then there are the upcoming innovative models, particularly the Polestar 5. If that car is commercially successful and well-received by critics and buyers, it could be a really significant catalyst, driving sales momentum and potentially higher margins.
So a lot riding on the new models.
Definitely. Continued expansion of their global retail network, often using those asset-light partnerships, directly supports their ambitious growth targets. More places to see and buy the cars.
Makes sense.
And we have to keep coming back to it, that strong backing from Geely. It provides a crucial safety net, strategic support, tech sharing, and potential access to funding if needed for continued investment and just weathering market storms.
Okay, Those are some solid potential drivers. Now let's flip the coin. What about the key risks that could challenge their progress or derail these opportunities?
On the risk side, regulatory uncertainty, especially around tariffs, is a major external risk. Unexpected duties could negatively impact their cost or even limit market access, potentially disrupting growth plans.
It's largely out of their control, too.
It is. Then there's the delay mentioned in the full SEC filings for fiscal year 2024. While it might just be administrative, any delay like that could temporarily raise compliance questions or just create apprehension among investors who want full financial transparency, now.
Sure, transparency is key. What else?
The persistent net losses and the company's history of significant cash burn are inherent risks. It highlights the ongoing profitability challenges and suggests a continued reliance on external financing or support from GLE.
So the funding needs remain a factor.
Yes. Also, difficult market conditions, particularly in Europe right now, where EV competition is especially fierce and geopolitical factors are creating economic uncertainty, could impact overall demand and potentially force more aggressive pricing or incentives, hurting margins.
Market headwinds are real.
And finally, there's execution risk. Failing to achieve their own stated profitability milestones, like that target of hitting positive adjusted EBITDA this year, could put renewed pressure on their liquidity position, even with the recent financing they secured. They need to deliver on those promises.
Okay, that lays out the balance clearly. Now, here's where it gets really interesting. How is the actual market reacting to Polestar, given this complex picture of progress mixed with significant challenges?
Well, it's certainly been a volatile ride for investors. Since Polestar went public back in late 2022, the stock has lost a significant portion of its value.
Yeah, it's been tough for many EV stocks.
It has. And Polestar's stock price has definitely experienced significant volatility, often tied directly to investor concerns about that path to profitability and just the overall EV market sentiment, which has cooled considerably from the peaks.
But you mentioned the recent Q1 results. Did they spark any positive reaction in the market despite the ongoing losses?
They absolutely did, yes. Following that Q1 results announcement in mid-May, the stock saw a noticeable surge. It climbed approximately 7.2% on the day, closing at 1.11 FEM on May 14th.
Okay, a 7% pop. What drove that?
It seems clearly driven by positive sentiment stemming from that strong revenue growth number, the 84% jump, and especially the significant improvement in gross margins turning positive. Investors saw tangible operational progress, even though the company is still operating at a net loss overall.
Okay, so the market liked the operational direction. What are we seeing from, say, institutional investors or Wall Street analysts following these results?
Institutional interest seems to remain, well, moderate. As an example, Deutsche Bank AG was reported to have increased its position, investing around $681,000 into shares as of late May. So some institutions are still involved or adding.
And the analysts who cover the stock, what's their take?
Analyst sentiment appears, I'd say, cautiously optimistic overall. They definitely acknowledge the strong delivery growth and that operational progress shown in Q1. But their views are often tempered by the fact that the reported top-line revenue number, despite being up hugely year over year, actually missed some of the higher analyst street expectations.
Oh, okay. So good, but maybe not quite as good as some hoped on revenue.
Potentially. And some analysts have taken a more conservative stance because of the ongoing cash burn and funding needs. Some even suggested it might be prudent for investors to wait until further equity is raised, feeling the company might need more capital soon despite the operational progress.
So some caution there about potential dilution or funding needs down the line. What's the overall consensus rating then?
Overall, the analyst consensus seems to lean neutral to cautious. You see a mix, but generally hovering around a buy or hold recommendation, reflecting that balance of progress and risk.
Okay. And what's the word like on, social media platforms? What are individual investors talking about on places like X or Reddit?
It's definitely a mixed bag there, too, as you'd expect.
Right.
There's clear enthusiasm among some about those rising delivery numbers. That 76% year-over-year growth is hard to ignore and gets people excited.
Sure.
But there's also palpable caution, lots of discussion regarding the timeline for achieving overall profitability.
Right.
When will they actually stop losing money? That's the big question.
Right. Anything else?
There's also chatter, you mentioned it, about potential future equity raises to fund operations. It's important to stress these are noted as unconfirmed rumors, so you have to approach that kind of social media speculation with caution, but the topic is definitely out there.
Understood. Finally, what did Polestar's own management say about their future outlook during their recent earnings call?
They held their conference call on May 12th to discuss the Q1 results. A really notable point was their decision to actually pause issuing formal financial guidance for the full calendar year 2025.
Pause guidance. Why?
They explicitly attributed this pause to the uncertainty around potential impacts from international tariffs and those evolving government regulations we discussed earlier.
Yeah.
Too many moving parts externally, basically.
Okay, so they're acknowledging the external risks. Did they give any other targets?
They did. They reaffirmed some ambitious long-term targets, specifically aiming for annual retail sales volume growth of between 30% to 35% per year through at least the end of 2027. So still targeting very strong growth.
30 to 35% annual growth for the next few years is ambitious. What about profitability targets?
They also stated a target of achieving positive adjusted EBITDA within this calendar year, 2025.
Positive adjusted EBITDA this year. That seems aggressive given where they are. How did analysts react to that specific target?
Well, as you might expect, analysts generally view this specific near-term EBITDA target as potentially challenging. Possible, maybe, but difficult given the ongoing market headwinds, intense competition, and the costs associated with launching new models like the Polestar 4 and ramping up for the Polestar 5.
Right, a lot has to go right for that to happen this year. So if we try to connect all these dots, the Q1 beta, the market context, the sentiment, the risks, how should someone listening think about Polestar right now based on everything we've covered?
Well, synthesizing it all, the picture suggests that a cautiously optimistic hold stance might be appropriate for many investors right now, based purely on this Q1 2025 data and the surrounding context.
Why a cautiously optimistic hold?
Because the operational improvements are undeniable. You've got strong growth, that gross margin turning positive is a huge step, and the losses are narrowing significantly. Their liquidity also appears solid, at least for the near term, following that recent financing. And upcoming products, particularly the Polestar 5, genuinely offer significant potential upside if they resonate well with the market and command decent prices.
But the caution comes from?
The caution comes from that history of significant cash burn, the fact they are still losing money overall, and the ambitious nature of their targets, especially that positive EBITDA target for this year. It introduces considerable execution risk. Can they actually deliver?
So monitor closely.
Exactly. It warrants careful monitoring of future results Q2, Q3 to see if this positive operational trend continues and strengthens before maybe making more aggressive investment decisions.
Okay, that makes sense. So wrapping this up, what does this all mean for you as you consider the information we've unpacked today? Polestar has clearly shown significant operational progress recently, turning critical metrics like gross margin positive and driving really impressive revenue growth. That's the good news.
But they are still operating at an overall loss, let's not forget that, in what remains a fiercely competitive and very capital-intensive market for electric vehicles.
Precisely. So as you process all of this, maybe consider this question. How absolutely crucial is the successful launch and market reception of the upcoming Polestar 5 later this year? How much weight does that specific model carry for them to not only maintain this recent operational momentum, but to truly accelerate their path towards sustainable bottom-line profitability, especially given they've paused their official guidance due to all the ongoing uncertainties in the global market?
Yeah, that Polestar 5 launch feels pretty pivotal.
It definitely feels like something worth mulling over as you look ahead at Polestar's story.
Indeed.
Thank you for joining us for this deep dive into Polestar. We really hope unpacking these materials helped you gain a clearer picture of their recent performance and their outlook moving forward.
Thanks for tuning in.